So if someone's trying to understand what a stockbroker does,
Right.
what exactly do they do?
Okay. So a stock trader, so the stockbroker from the floor side is somebody who basically is at the point of execution of buying shares of stock from a market maker. Orders are generated upstairs. Think about this. You wake up in the morning, you're at Goldman Sachs, Wells Fargo, Morgan Stanley. Everybody shows up for the morning meeting. They have a customer base and assets under management. Hundreds of millions of dollars. They're there to invest people's money, right? So their goal, and they have a crew of analysts who decide what they're going to invest in, okay? Obviously, the better the firm, the better the analyst, the better the prediction of how the stock is going to move. So the analysts make a prediction on what they think are good investments. They come to the portfolio managers, they sit down and they decide, okay, we're going to buy 1 million shares of this, sell 2 million shares of that, whatever it may be. They sit down at their morning meeting and they say, today we're going to buy 1 million of this, sell 1 million of this, and we're going to go in and out of stock, right? Those orders are all generated upstairs. They are called down to the floor, at least in the old days. They would be called down to clerks on the floor. The clerk, he'd say, buy me 100,000 shares of IBM. I have 1 million shares behind it, meaning there's more stock to buy behind it, but I'm giving you 100,000 to buy right now. Go out there and give me a feel on what's going on in the market. Go to the market maker and ask him, where are the buyers? Where are the sellers? Where can I buy 100,000? I may have more stock behind it. What's the market? The market means what's the playground look like, right? Who's there? Who's buying? Who's selling? What's the temperament of the stock for a while? Order is generated up here. It's called down to the clerk on the floor. The clerk will then put up the broker, right? Me, I'm one of the house brokers, or I'm a $2 broker. And he'll say, Peter, we've got 100,000 shares to buy. I'd like to buy half of them in line. I'd like to work the rest of them. And we have 1 million shares behind it. It's kind of Wall Street lingo, but you can get the sense of it, that we have stock to buy. I would then go out to the market maker. I think I gave you a little background on that on the floor. The market maker is an independent firm that has been allocated the stock by the New York Stock Exchange. He's there to create a smooth and active market. He's there to inject liquidity into the marketplace. He's there to coordinate the buyers and sellers. So I'll say, guys, we're going to bid a quarter for 200,000. We'll talk. And the sellers will go, you know what? Great. We'll sell 250,000 shares. The market maker, if there are 4 buyers and 3 sellers, the market maker will then step in as a seller to consummate a bigger trade. If there are 3 sellers and 2 buyers, the market maker will buy stock to consummate a bigger trade. This is all a negotiation.
How do market makers make money if all they're doing is injecting liquidity into the market? Are they taking a certain percentage off of each trade, or are they employed? Is it like a government thing? Are they employed by the New York Stock Exchange?
No, they're employed by their firm, but what they do is they buy low and sell high. So his job is to constantly be buying and selling, facilitating the trades, but in the meantime, making money. His goal is to buy low and sell high. Mm-hmm. You have to realize, in the absence of a public buyer or seller, the market maker has to buy the stock or sell the stock. So in the case of a crash, the crash of 1987, where the market opened and proceeded to sell down 600 plus points, or 30+%, stocks went from 160 to 60. At one point, the public stopped buying the stock because they ran out of money, or they watched their positions go down 100 points. The market maker had to participate all the way down. So at the end of the day, on Monday, the day of the crash of Black Monday, the market makers were long. They owned tons of stock at much higher prices. At the close of business, if you'll remember that great scene in Trading Places where they tried to confiscate their seats, they said, Mr. Duke, you know how it is here. At the end of business trading, you have to come clean with how much you need money to capitalize the trades you own. So if the market maker was buying stock all the way down to 60 from 160, he needs to have money in the bank to support those trades. Many companies went bankrupt on the crash, the Black Monday, because they didn't have the money to support those trades. Okay. But obviously their goal is to facilitate trading between public buying and selling and make money along the way. It doesn't always happen, but that's the goal.